All right, what's up, guys? Welcome back to another episode of the Living the Dream podcast. Today on the show, we have Seth Hicks, who is a private banking and asset protection expert. He is the host of the Private Banking Strategies podcast, and he is the COO and general counsel at Private Banking Strategies. Seth, how you doing?
Hey, thank you so much for having me on, Timothy. I really appreciate it.
Of course, man. Thanks for coming on the show, and we like to jump right in. So if you can start with just telling us a little bit more about yourself, what you like to do for fun, that'd be great.
Sure. Well, I got a big family. I got six kids. So I'm soccer coach. I'm a fishing guide. I'm hunting guide. Uh, they keep me young. So I spend a lot of time with doing family things. I got four boys and two girls, 8 and under.
Huh.
Can you believe that?
8 and under.
Yeah, six kids, 8 and under.
Are any of them twins or anything?
No, no twins.
Oh my gosh.
Yeah. People look at me like, you're crazy.
That's insane.
Like I said, it keeps me young, man. I got to make sure I'm well exercised and flexible. So if I'm not hanging out with them, I'm doing a little exercise so that I can keep up with them.
Was what was the turnaround time between pregnancies?
The first four were a year apart, and then we had about a 2.5, 3 year gap, and then a year after that. So five of them are a year apart.
I gotcha. I gotcha. Okay. And by a year apart, do you mean like
Like,
3 months afterwards?
yeah, I'm talking like one turns 8, and then the next one turns 7, like a week after they do. Their birthdays
Oh,
are real, real close. So,
you guys were turning around basically
yeah,
as soon
just
as you
just
could.
turning it around. We're pumping out kids.
Oh my gosh. That's awesome, man. I love the energy. I um I want to have 6 kids.
Nice.
My wife does not want to have 6 kids.
Right. Yeah.
So,
We didn't set out on that course for ourselves. It just unfolded that way.
yeah.
But we just felt like, be fruitful and multiply.
Yeah, absolutely. I feel you. Well, tell us a little bit more about what you do. You're a private banking and asset protection expert, host a podcast, and you're the COO at Private Banking Strategies. Tell us what all that entails.
Sure, sure. What that means is that I've been practicing law for about 25 years. And I met who is now my partner, a gentleman named Vance Lowe, who was in financial wealth management. He's a money manager. He's in his early 70s. He's been managing money since his late 20s. And he discovered that there was a better way of creating financial freedom, of keeping what you make, growing it safely, and all in a tax-free environment. And that is private banking strategies. So we use a supercharged whole life insurance policy, which is dividend paying and issued by a mutual life insurance company, meaning you as a policyholder own a portion of the company, as opposed to a stock company where you have stock in a company. And that makes a big difference. But we use that as the cornerstone for banking, where some people, they have multiple hundreds of thousands or millions of dollars in Wells Fargo or Bank of America. Well, we educate people as to why that's not a safe place to keep your money and why you should keep it in a whole life insurance policy, and how it's far superior. So that's kind of the 30,000 foot overview. There's 7 pillars to private banking strategies, which include asset protection, tax-free environment, financial privacy, getting multiple touches on your money, and a few others. But that's kind of the 30,000 foot overview.
I gotcha. I gotcha. And so, with the whole, like, why is the banking in the whole life insurance policy solid for somebody? And then how does it supercharge wealth creation and financial freedom timelines?
Great question. Great question. Well, life insurance has been the primary method for banking for hundreds of years. before what is currently known as branch banking came into the forefront of our culture, which happened after World War II. And so older folks like my parents and baby boomers, they were conditioned at school, open a savings account at your local bank and bank money there. But prior to that, I mean, from, the 1600s, 1700s, they were done, banking was done through life insurance contracts. And it boils down to a simple black and white systematic way that those two systems operate. One is centralized banking, is built on a fractionalized and derivative banking. So when you go into Wells Fargo and you have $100,000 in there, Wells Fargo is only required to keep $10,000 in reserve, and $90,000 of your money they take and they loan out for homes, for autos, for business loans, and they make money on your money that they never generated, earned, created, or otherwise. Whereas life insurance is not doesn't have the same luxury of being able to multiply money out of thin air. I mean, because effectively that bank is making money on your money. And if you want run to the bank and you want all your $100,000 out, and all of the rest of the depositors do at the same time, they don't have the money.
Yeah, banks collapse. Yeah.
Banks collapse. And point in case, Signature, Silicon Valley Bank, Signature Bank. Another one I'm drawing a blank on it. There's been 3 or 4 bank failures just this year, and they're mid-tier banks. Like Silicon Valley Bank had like 210 billion under its management, which is a mid-tier bank. I mean, the top 5 have into the trillions, and there's 20 trillion total cash deposits in U.S. deposited banks. Okay, so and the FDIC is worth about, let's call it liberally and very generously, $100 billion. So you have the FDIC, which, as you probably are aware, it insures your deposits at Wells Fargo, Bank of America, all the FDIC insured banks up to $250,000 an account, right? Are you aware of that?
Yep.
Yeah, most folks are. It's a sticker. When you walk in the door, you're like, and if you got under $250,000, you think, oh, it's safe. Well, not really. Not if the insurance company doesn't have enough money to pay out on all the deposits. And there was a recent video that was a roundtable of an FDIC special committee, which was discussing that very point. And they were saying, there is a very big elephant in the room, and that is that this FDIC is not solvent to insure all the deposits. And if that information actually becomes common knowledge to the general public, we have a problem. There's going to be bank runs. How do we manage this information? How do we control this in social media? And they were roundtabling how to effectively manipulate the general public's knowledge that the FDIC is not solvent. And that was shocking to me. I watched it 3, 4, 5 times. I'm like, did they really just say that? I mean, I know that, but this is something that I study and I live and breathe and eat, and I couldn't believe it. So we, push that out to our clients and like, hey, tell your friends, if you've got over $250,000 in a bank, or if you're in a bank that it smells like it's insolvent, you need to take precautionary measures to defend yourself, so to speak. And so life insurance, on the other hand, Timothy, is not able to fractionalize deposits. They have to have $1 on hand for every dollar that is paid in premiums. And when a death benefit is due, they have to have the cash right there to make the payment on to the insured beneficiaries. And so it's a totally different economic compliance. And so that's the fundamental difference. Life insurance companies, like I said, have been around for hundreds of years, paying these dividends and paying growth without fail through the Civil War, through the Great Depression, through every other economic downturn. And that's what makes it a far superior, one reason it makes it a far superior alternative to traditional centralized banking.
I gotcha. And so I'm curious if they have to be so like, I have a dollar for every dollar I've gotten. How are they providing the return that you get in a whole life policy?
Yeah. Well, they invest the money that comes in, and there's also other growth. It's not all just dollar for dollar. There's growth on their funds. They invest in real estate. They invest in various sectors, but they're very, very good at it, as opposed to a centralized bank, which is effectively creating money out of thin air. There's in the 40-year course of my partner's tenure, he told me that he's had seen like 3 life insurance company failures or insolvencies, and not even large ones, and they are quickly absorbed and purchased. He says like within a week, because of their cash value and the liquidity that's on the balance sheet by a larger insurance company. And so all the policies are still paid, all the growth is still there. It's like hare and tortoise, because a lot of times we'll see folks, and he was a money manager, so he's going for larger returns. Someone will say, oh, we can make 13% a year in this investment, but the statistics show that the turtle actually wins the race. And so the 4% guaranteed that these life insurance companies are now offering, plus dividends, comes between 6 and 7%, will outperform over time. I read an article just recently that said over the last 20 years, which was in the stock market and stocks and equities, it's been the longest bull run in history, and the actual average return on account has been 4%. So,
Mm.
and you go, well, how does that reconcile when you've got funds that are claiming 30%? And well, sometimes it's funny math, and sometimes it's like they may double money one year and then lose half of that the next year. Well, you're right back where you started, but they don't have to tell you, that they're at a zero sum. They can say we made 100% last year, and so they've got ways that they move around actually what is made. But for me, it's been one of the biggest, personally, just one of the biggest light bulb experiences that I've ever had. I mean, and I wish I'd have known about it when I was 20, because the sooner that you get started, the longer the growth curve sets you in a parabolic wealth accumulation.
I gotcha. I gotcha. And so you said you're using it as a banking strategy. So like if somebody's 20 listening right now, would do they like put their whole paycheck in this policy? Like how does it work?
Yeah, how does it work? Well, interesting story. One time, one of the OGs in this particular sector, named Nelson Nash, and he is famous for coining the term infinite banking concept, and that's a term of art in the industry that uh, entails this whole life insurance as a cornerstone of banking. And he was asked that same question, and he told the person asking the question, you want to get to a place where, yes, all of your income is going into your own banking system, and that you're getting multiple touches on the dollars that come under your control. So you want to keep what you earn, and effectively think like a bank and put that money to work in good investments, good loans, and have as little consumptive and slippage on the money that you earn as possible. So that is the ultimate goal. But where people start out, that's not really realistic, and that's not really possible. So you analyze where you're at, and we help you do that. And we do an 8-year roadmap and analysis that kind of lays things out for you where you are. And we say, hey, take your bank cash liquidity. I'm talking about your private bank that you create through this whole life insurance. Take the cash value out of that, purchase that high interest credit card debt that you've got that's creating drag. It's like weight on your airplane holding you down. And you purchase that $10,000 credit card debt, but you keep making the payments as if you were still paying the credit card, except you make it to your own bank. So now you thought like a banker. I'm thinking like a banker. I'm making a good loan because I'm looking in the mirror going, my borrower is trustworthy. He's going to pay my bank back. And so then you start making payments back to your bank, except now you're getting interest on those in a tax-free environment, and it's compounding year after year and growing without any drag. And then you go, okay, we take the cash value as it's going up, and it goes up every time you make a payment. So you can put it in and it goes up dollar for dollar. So you start a $10,000 policy and you got $10,000 in cash value, and you take out a $10,000 credit card and you start making $500 payments. Every $500 payment, you've got that same liquidity in your bank coming back up. And so then you take out another credit card, or you go to the next level. Let's say it's an automobile. And you say, and I'm not going to finance it through a third party or the car dealership, even if they've got some incredible rate, because you got to think like a banker. I want the cash flow. I want the stream of cash flow that's come under my control. I've got money coming under my control that I can afford to buy a car, and I want to finance it through my bank. And so that cash flow and the interest, all tax free, remember, and compounding year after year, is in your bank. And then you go from an automobile to a investment property or to a home. And so that's the way that you leapfrog and keep going higher and higher when you're 20.
I gotcha. So it's like, eventually you get to the point where you have 20, 30,000 in cash value in your whole life policy, and you use that cash value to then buy a car. But
Correct.
instead of making payments to a different bank, you're making payments back into your own bank where you're basically compounding your money through the return the insurance company's giving you.
You got it. And let me explain, give you a little sample illustration. So you got two people, let's call them twins, okay? And uh, twin one decides they're going to finance the $30,000 vehicle through the car dealership, okay, at 0% interest, okay? And you got twin two that's going to use their private bank and buy the same car from the dealership. They're going to pay straight from their own bank to the car dealership, and they're going to pay themselves back 10% interest into their own bank. Well, at the end, let's call them both a 7-year note, 7-year term. Twin number one, at the end of 7 years, he owns his car free and clear, and it's depreciated from 30,000 to 15,000. He's got a $30,000 vehicle when he purchased it. Now it's worth $15,000. Okay, great. You're worth $15,000 in a car. The other twin two, he's paid his bank back all that money that he used through his cash flow. So he's got 30,000 plus what's compounded for 7 years and grown, which isn't going to be 30,000. It'd be more like 40, 45. And he's got a vehicle that's worth 15,000. So instead of being worth $15,000 in a car, you're 45,000 in cash and 15,000 in a car. You're worth 60. So you're worth 4 times as much using your own private bank. That's rough numbers and illustration, but the concept is the same. That's the concept.
I gotcha. I gotcha. I guess the confusing part to me is when you're paying the money. Um, so like to access the cash value, you have to take out a loan from yourself, right?
Correct.
And then when you're paying that back, the money you're paying back is just increasing the cash value you have available.
Correct. It is, but it's also compounding and growing inside your policy.
Yeah,
Okay.
yeah, yeah, yeah.
So
I
it's
got
not just cash value. It's also the fact that you're getting paid dividends on the amount that your policy is worth. And there's different types of policies, but some policies, even when you've withdrawn your cash liquidity from your policy, they still treat it as if it's still in there, and that's called a non-direct recognition policy. But that's off in the weeds a little bit. So they're still growing and compounding like you didn't take the policy loan out. And then when you're making cash payments back, you're getting credits for what you're making back, and it's growing and compounding, and there's no tax consequence. There's no tax consequence when you pull it out. There's no tax consequence when you pay it back. There's no tax consequence when the actual death of the insured occurs and the death benefits paid to your wife or to your children. There's no tax consequences. So you add that in there, and people really, when you equate for that, there's nothing that compares to this on earth.
I gotcha. So say I'm 21, I can start a policy right now. I have $5,000 liquid and I can put $100 a month into it, right? I'm curious if I suddenly became a realtor and I sold enough properties to have 100,000 liquid in my bank, could I then transfer that all to my whole life insurance policy, or would I have to get a different policy opened for that?
It's a great question. That's very astute. There are different ways to create like an option, I would call it, and it's through what's called the term rider to your whole life insurance. And it effectively is something where if you have a windfall or you have a lot more cash come in, that you can take that term rider and convert it into a whole life policy without having to qualify again, without having to do any medical exams or having to do any financial qualification, and expand the size of your bank from that $5,000 that you described to a much larger amount. So that's one way to do it. Or two, yeah, you get another policy on someone that you have an insurable interest in. You have an insurable interest in yourself, have an insurable interest in your wife, have an insurable interest in your children. You have an insurable interest in business partners. So there are a lot of different variables in how to expand your bank. We had one gentleman that my partner was affiliated with and was a protege of, had over 100 policies. Most of them were in business relationships. So if you come to a place where an insurance company goes, well, you got, $50 million in death benefit, we're not going to give you any more insurance. You can still increase the size of your bank with having insurance policies on business partners or other blood relationships. Yeah.
I've heard a little bit about infinite banking, but it blows my mind every time I hear about it. Every time, like
Yeah.
without fail, I'm just like, so why are people not taught this growing up? Why is this not the way that everybody banks?
Right. Well, it's a great question. I think that there's some misinformation out there with folks like Dave Ramsey and Susie Orman, who they, poo-poo all over because they don't know anything about it. I heard Susie Orman say, she's worth $70 million or something like that, maybe closing in on 100. And she was distraught because when she dies, her partner is going to have a $50 million slippage in Susie Orman's estate because she can't get away from estate taxes. Well, and she's like, I just don't know what to do. Well, it's real simple. You bank in whole life insurance where you've got tax exclusions. It's not a hard thing to understand. Here's another example. I mean, the artist formerly known as Prince, he was worth about $200 million when he died. He was a resident of Minnesota. His beneficiaries lost more than $100 million to the state of Minnesota and to the IRS because he had no legitimate estate plan in place, didn't have any type of private banking. Now, contrast that with someone who has this, like, let's call it a grandparent that has policies on themselves. They have multiple tens of millions of dollars in death benefit flow into their children's policies into their control, and the same thing when the parents die, but that's just a multiplied amount into grandchildren. It creates a waterfall of wealth that is really not earned. There's no ingenuity in it. You didn't put, a Tesla in development. You didn't put a rocket on the moon. It's just simply a function of a wealth strategy to create generational wealth. Some people are like, well, I'm dead. What do I care? Well, I care about my family. I care about my kids. I care about my grandkids. And most people do, and they want to create a financial system that helps their family become financially free.
Yeah, yeah, absolutely. I love it. I love it.
Here's another interesting thing that we do our own podcast, and we're drilling down on putting policies on your kids even from a newborn age. And there was an illustration that we laid out $2,000 premium per year on a newborn. When the person was of retirement age, they had $8 million in cash value to draw out on. That's all tax free. So it's not even, they tax you on Social Security now. I mean, unbelievably, you put in money in Social Security. Now that baby boomers are drawing it out and you actually get taxed on it. Well, this person who had this policy in place that their parents and had set in place, when they became retirement age, they had $8 million in cash value. They did nothing for, nothing they'd earned. They didn't contribute to it at all. And they're able to pull that out for retirement for whatever purposes. And it's not just at 70, they can get it out when they're 20, they can get it out when they're 30. But the parabolic effect of growth will blow your mind. And in that illustration, it's doubling or tripling about every 10 years. So if it's $800,000 at 30, it's going to be about 2 million at 40, 4 million at 50, and so on. And
Mhm.
that's, kind of blows people's minds. And all it's doing is compounding and growing without you doing anything. So, and when you actually put the banking aspect to it, Timothy, when you're using it like I described, taking out cash value, taking out things that drag your wealth curve down, credit cards or even third party loans, or when you actually accelerate your growth by using it as your cornerstone of bank. But in that particular instance, that person did nothing.
Yeah. Dang. And so I'm like, it, it it starts to double or even triple like when you start to you use the cash value. Yeah, you got to pay off debt. Like a lot of people have debt or whatever, but then you go and get good debt like real estate, or maybe you purchase a business that has X amount of cash flow and you can buy more of these policies and you increase your cash flow using your bank that's compounding over here. Like I feel like it just starts to escalate so quickly.
That's what we call the velocity of money. And it's one of the pillars of private banking strategies. And velocity of money means getting multiple touches on the same dollar. So you fund your bank with a dollar, you pull that dollar out in a loan, you take that same dollar, you purchase a piece of real estate. That piece of real estate spins off cash flow in the form of rental income, and you take that same dollar and pay your bank back. So you've gotten 5 touches on the same dollar that you've put in motion for different purposes. And of course, there's some slippage with real estate and things, but you've got a profit there that pays your own bank back. And so that's called the velocity of money. That's called a tailwind, a lift on your plane rather than a pull down and a drag. And real estate and private banking work hand in glove. A lot of people that we work with are real estate investors, are real estate developers, or business owners. Things they own things that have cash flow that they can expand and acquire and expand and grow their business through their own banking, and get the money back and put it back into their bank and expand again and rinse and repeat.
Yeah, so I guess I was curious, do businesses ever have their own like whole life insurance policies where they're tapping into the cash value, or can only individuals have it? Does that question
Great.
make sense?
These are great questions. These are amazing questions, actually. I normally don't get questions as astute as these. The answer to your question is yes. You have employer-owned insurance policies on employees, and ironically enough, some of the biggest clients of the life insurance companies are your centralized banks like Wells Fargo, Bank of America. Last time I checked, they had like $20 billion in annual premium in life insurance on their policies. And can they use that cash value? Absolutely. And here's how they do it. Then they only cut off a little piece for the employee when that employee dies, for the employee's family. They say, hey, as a benefit to you, we're going to give you a $25,000 death benefit to your family. And they go, okay, great. And so if that employee dies, they cash in on 500,000 and they peel off 25,000 for the family. So they get a massive influx in death benefit, but at the same time, they're getting to use all that cash value
Yeah.
for for whatever business purpose they need. So it's the same concept with small business owners. They do the absolute same thing. We've structured numerous employer-owned benefit plans where they're offering these packages for employees, which employees like, but the employer also benefits greatly.
Yeah, I was my initial reaction was, oof, that's a little grimy. But then I'm like, so many people are happy to get that
Yeah,
25,000 when
sure.
the breadwinner passes away.
Right. And it doesn't have to be that lopsided. I mean, and it's up to the employer and how they structure things. And so, but yeah, there's also ways to create like loyalty incentives. If the person stays 10 years, 20 years, 30 years, retires there, that they give them bonuses, $500,000 bonus, or
Yep.
whatever. And it's all through that life insurance component. And then when the person passes, the employer kind of gets paid back in part. So it's a win-win.
Mm, man, it's like a whole different world of
Totally.
finance.
Totally. Yeah, it starts to blow your mind when you start getting into some of these places, and it's hard to sum up in 7 seconds when you're like, well, what is private banking strategies? It's a whole lot.
Yeah. Yeah, I gotcha. I gotcha. Well, Seth, tell us a little bit more about your motivation. What really gets you up and keeps you going with all this private banking stuff?
Sure. I like to create um, security for families. I like to see folks out there in middle America, regular America succeeding. I like to help folks create financial freedom and to effectively keep what they make, and grow that safely. And this is the best way to do that. So it motivates me to help people in that regard. I mean, I'm an attorney by first education, but I use that skill and that set of maybe gladiator skills to help people make their family secure, and that brings me a lot of joy.
Yeah, I love it. Well, what's your vision for your companies? What's your vision for how many families you impact with private banking strategies?
Yeah, that's a great question. There's in our whole industry of folks there, we were like, if you have a 10% of the US utilizing private banking strategies, infinite banking concept type strategies in a economic collapse that would otherwise take the country down, it wouldn't become insolvent if just 10% of the people were utilizing this type of banking. And so that would be a very lofty goal, but 10% of the U.S. population utilizing it, and I think there's quite a bit of room to grow in that. There might be 1 million or 2 million people utilizing this type of strategy. I'm not sure what our total population is, maybe 350, 400 million.
Yeah.
So if 35 or 40 million, 50 million people were utilizing this, I think that we would be bulletproof financially.
Yeah, and it's not just for the cash flow heavy entrepreneurs or business owners, right? Like anybody can start using this, and you might not be able to take out a huge loan from your cash value and buy a piece of real estate, but you can start now. Is that right?
That's right. That's absolutely correct. And we had one of our superstar testimonies that I like to tell people about is a single mom. She was widowed, had a number of kids in Central Texas, and she started with a $5,000 policy a year. And she, faithfully plugged away, utilized it for, like we talked about, credit card debt, cars, and then she bought a piece of investment property, and she's been at it now for quite a while, over decades, and she's got over $1 million in real estate assets that she has acquired. And some of that is using your own bank, like let's say for a down payment, which then in effect acts like a second mortgage. So you still finance it through a typical bank on a real estate asset because you don't have the other money in your bank, and then but you're able to actually pay down that first mortgage to Wells Fargo or Bank of America much, much faster, and earn the right to own that property free and clear only with your own bank being owed any money, which is, is effectively owning it free and clear. So no, you don't have to be a total rock star, and making millions of dollars to implement this. It's a strategy that works for anybody and everybody, and you start where you are.
Is there a minimum monthly premium payment that you have to be putting into these policies? Or like, so, if she's doing 5,000 a month, what is that? Or 5,000 a year, what is that a month? Like $400 or something like that?
Right, right. Well, yeah, there's different ways. You can fund these on an annual basis, so like lump sum 5,000, or you could break it down into monthly payments. But no, there's no minimum necessarily. I mean, we suggest that people look around for things that don't bring any income, don't have any real appreciation value that they might own. Like you got 4 cars, and you just like to drive a different one on different days. Well, liquidate two, fund a policy, learn ways to be less consumptive. You don't eat Starbucks every day. That adds up fast.
Yeah,
And there's other ways that you can tighten your belt to actually redirect money to keep it within your control and in your flow. So my partner is really good at helping people analyze those things and make sure that they fund their policies and continue to grow and keep what they make.
I gotcha. I gotcha. And then back to the example you just talked about. She started with 5,000. Now she owns 1 million in real estate assets. And you said eventually you can get to the point where you can use that cash value as a down payment and it'll help you basically act as a second mortgage. You get the maybe 70% from Wells Fargo, 30% from yourself, right? Is that kind of what you were talking about?
Yeah, I mean, or it would be, maybe do an 80-20. If you want to buy $100,000 investment property, uh, you probably be able to find those in the South in some places, or and you got $20,000 in your policies. That's your down payment, and Wells Fargo finances the 80. You own the property subject to the Wells Fargo mortgage, and then of course you're paying yourself back. That cash flow that you create with that entity pays you back, pays the first mortgage back. There's a profit in there. There's a delta. You follow me?
I see. Because then you can, so the cash flow, it's paying Wells Fargo back, but it's paying you back, which is increasing your cash value. Then you could take out more of the cash value that you just recuperated and pay more of Wells Fargo back to accelerate the
That's right.
process.
That you got it.
I
Exactly.
see. Yeah, I was missing that piece there, but that makes a lot of that is genius.
Yeah. And so your bank goes from 20% to 30% to 40% until it's 100% of the lending entity on the asset, and you keep it that way. And and so then you rinse and repeat. Go do that with another property. And if you had more cash in your bank, let's call it 100,000 instead of 20, you could go out and buy 5 properties, put 20,000 down across 5 properties, have the bank finance the other 80% on those 5 properties, and you just increased your cash flow by 5x on that.
Mhm.
And then you're actually in a much more rapid acceleration of paying those first mortgages down and off. And you're creating a much more parabolic wealth curve with 5 pieces of real estate as opposed to one. Of course, you had more in it. You could have taken the same $100,000 and just bought that one property and subject only to your own banking entity's loan. And you'd have, let's call it $2,000 a month in cash flow. But if you multiply that times 5, you got 10,000 a month, 120,000 a year, and it moves a lot faster.
Yeah,
That's called
absolutely.
that's called leverage. That's the concept of leverage.
Yeah, and so speaking of leverage, when you start to talk about it, a lot of people can get really scared because of defaulting. And so what happens if you're able to pay Wells Fargo back, but you're not able to pay yourself back 1 month or 2 months or 3 months in a row? What happens then?
Nothing happens then because you're the banker and the borrower. You just restructure the note. There's never going to be a foreclosure. There's never going to be a catastrophic event in that case because you just restructure loan terms and ride it out till things are back to where you need them to be. But it is important that you pay your bank back for the whole system to get
Yeah,
that total value that you've got. Because some people are like, I'm gonna take a vacation every month. That is no, you need to pay your bank back.
yeah,
And it makes a difference when you're 60 and when you're 70 and you've got 8 million bucks in cash value to draw down on. And that's called financial freedom. You know what I mean?
yeah.
So
I
I'm
got you.
I'm I'm a big believer in like, yeah, I mean, I pass by Starbucks. I like the coffee, but I can make coffee in my kitchen for 10 cents. You know what I mean?
Mhm.
And so can I afford Starbucks? Yeah, I can afford Starbucks twice a day, every day, but I don't, you know what I mean?
Yeah.
It's like, do I enjoy things? Yes, I enjoy things, but I don't waste. You have to still be a good steward, and you have to think like a good banker and get that money back. That's how making money, that's that cycle that really gives you the value.
Yeah. Yeah. Absolutely. And so you're telling me you can just restructure the loan terms. Never are they gonna like collapse your policy and say, you gotta go.
No, no, never. No.
That's insane.
Yeah.
That is so, so cool.
Yeah.
Man, yeah, we need 100% of the US on this. We need the world on this banking system.
Absolutely. It's the difference between Keynesian economics and Austrian economics. And if you look at those two different diversities, one has to do with just the inflation and printing of money and fractionalized banking, and the other is the complete opposite of that. And so I agree with you 100%. The whole, if the US, if everybody banked like that, if everybody really understood the risk that they're subjecting themselves to with fractionalized banking and centralized banks, they wouldn't do it.
Yeah,
So we blow a trumpet, we blow a whistle and tell folks, and it sinks into some, but some are so brainwashed. A lot of people are brainwashed. In fact, I mean, I was brainwashed. I'm thinking, no, money in my bank account is my money, and it's going to be there when I want it, and it's just not the case. And as a lawyer, when you actually look into the Dodd-Frank Act, which is what allows the banks to bail in on deposits, and you understand what's written, it blows your mind. But most people have a tough time actually believing it. They just kind of think, well, something will happen. They just think it's going to work. It's all going to work out until it doesn't. So, but even just aside from safety, the actual ability to grow and not pay taxes on this, what you put in and what you take out, and all the various benefits, it just like blows everything else out of the water.
yeah.
Um,
No, I mean, that's what really gets me. It's like with that real estate example was so potent to me, where it's like, okay, you take a 30% down payment or 20% down payment, you get 80% from the bank, and then the cash flow from the real estate, because if you buy a good piece of real estate, it's going to cash flow, pays you back, which allows you to pay off the bank faster. It's like, because usually that down payment would just be sitting in equity in the home doing nothing, like literally nothing.
right.
And so that is so,
You got it. I mean,
oh
you
my
got it.
gosh.
Yeah, that's sharp that you put these things together quickly, because a lot of folks, it takes some time. We have clients have been, with us 5, 10, 15 years that are listening to a podcast or hear something, read an email, and they're like, I got it. I got that aspect of it. It's so robust and 360-degree view that it's like it's jujitsu, man. I mean, when you go in the first time, you're not going to have a black belt, but you just keep going and keep rolling. You keep getting better and better. And that's the same thing with this. There's just so many different aspects to it that you can increase with. But at the same time, it's as simple can be. I mean, you just put it in place and follow the steps that are laid out for you, that we lay out. So it's not hard, like like you can't understand it. It's just simply uh, sign on the dotted line with the insurance company, fund your policies, and follow these steps.
Yeah, yeah, absolutely. Well, awesome. Seth, are there any of the financial pillars, anything that we missed talking about the private banking strategies that we can go a little bit more in depth in the last 12 minutes?
Sure, man. I mean, one of the things that I like to talk about with the legacy waterfall, and we touched a little bit on it, but folks that have young kids, and or maybe there's grandparents. Grandparents say, well, how do I implement this? I'm 80 the way that you implement it is with your kids and your grandkids. And there's the tax-free benefits that come from when someone passes on those policies to the next generation is incredibly valuable to fund new policies and also to acquire cash flowing assets. So just like we're talking about, if you've got policies on kids, on grandparents, kids, and grandkids, when the grandparents die, and there's multiple millions flowing into the children's hands, goes into their policies, like we talked about with term conversions and additional policies. When the parents die, think about that multiplied effect. Instead of it being $5 million, it's now 25 that flows into the grandkids. And so that generational wealth waterfall is something I think is incredibly powerful, especially for folks that are interested in family. You know.
Yeah, 100%. And I heard that this is how some of the wealthiest families keep their money. Like something like the Rockefellers have been using this strategy since they stumbled upon their fortune.
Oh, well, you name it. I mean, you've got John F. Kennedy, you've got Nixon, you've got uh, tons of different presidents and politicians that utilize it because they realize the value of the tax-free environment and the compounding growth. It's not going to change because all of the banksters use it, all of the politicians use it. It's a little known hidden secret. J.C. Penney was created and built upon this. Ray Kroc, who was the originator and franchisor of McDonald's, utilized this. Pampered Chef. I mean, I could go on and on and on about massive success stories, well-known, ultra wealthy people that utilize these very systems and techniques to grow and keep their wealth. So it is available to everybody. It's just not everybody understands or knows about it. So the more people that we can reach with the message and help them to have the light bulbs come on, the better.
I feel like there's a huge opportunity for like people who just have equity sitting in their home to like refinance that equity and fund a really big policy and then start, escalating their financial freedom because it's very similar to that real estate deal where it's like you just have the 20% sitting there. I feel like, I mean, I think there's like $5 trillion sitting in home equity across
Yeah.
America.
Well,
And so
it's a great place. We call it finding the money. Like people go, well, I don't have the money to fund a policy. But like I said, you're sitting on 4 cars, or you got $500,000 in equity in your home, and you're absolutely right. You can take that same cash value in equity and transfer it into a banking system, utilize that same cash in other investments or in other types of debt that are dragging you down, and turn it into a lift. So home equity is an absolute great place to find money. I suggest that you do it within conservative measures and means. If I got $500,000 in equity, I'm not taking it all out and putting it in banking. That's over leveraged to me. But I
yeah,
may take half of that equity out and spread that into annual premiums over 5 years. And then I'm looking for cash flowing returns, or if I have an investment and I see a cash flowing return and I see the value of purchasing that through my own bank, and the leapfrog is through my equity in my home, then absolutely. That's the greatest way, is to put it in place when you've got targets for investment.
yeah. I mean, I've seen real estate investors who are raising money get people to take out home equity lines of credit to like invest in their real estate deals. I'm like, if those people just added one more step between that, took out the HELOC, put it in a uh, whole life insurance policy where they can maximize the cash value, and then took it out and put it in it would just basically, oh my gosh, I love this. I
You
just love
got it.
thinking about it.
Yeah, no, you got it. You hit the nail on the head. And that's called the velocity of money, like we touched on. You're getting multiple touches uh, on the same dollar. You're putting that dollar to work in multiple places. And as long as you've got your structure and your math straight, and then you're going to be just adding and accumulating and growing.
Yeah.
And that's why I said to you that real estate and private banking fit hand in glove. It's one of the easiest ways to calculate how you're going to put that to use and how you're going to use your cash value in your bank to purchase real estate. And you generate conservative pro formas on your investment real estate. You don't say, you don't get too lofty. You provide for vacancies. You make sure your real estate taxes, your insurance, your make readies, all those type of things are straight. Or if you're in commercial property where you don't have some of those things, or a storage facility where you don't have any of those things, you dial that in and you get it tight, and then it's just rinse and repeat.
Yeah.
And I did probably 50 fix and flips in the last couple decades, built from the ground up, had lots of tenants and toilets, and it's a great way to accumulate wealth. But I've found better systems in commercial real estate, self storage, other ways that you don't have some of the same risk. And especially with COVID and tenants not paying rent, and deciding that they weren't going to pay rent, that created a lot of landlords some big headaches. So you have to build conservative pro formas in your real estate deals. That's kind of an aside, but um, that being said, I mean, it's real estate on steroids when you fund through private banking, and you've got the ability to create leverage like we talked about. No better system that is on earth.
Yeah. Yeah. I got you. Well, awesome, Seth, man. I think we're gonna end it right there. Like,
Awesome, Timmy.
yeah, thanks for coming on the show. We really appreciate you. If people wanted to know more about this, where would they find you?
Yeah, our website is privatebankingstrategies.com. That's privatebankingstrategies.com. And there we've got a free book offer where you can read or listen to, which kind of acts as a red pill book, talks about some of these same issues you and I have been talking about. And there, in you exchange your email, and we'll send you valuable educational emails. And then we've got podcasts on the shelf there for you to choose and pick through. By I think there's probably 50 or so already, so you can drill down and learn about all different aspects of things, and make sure that when you put your email in, that they tell us that they came through your podcast, that they came through your exposure and your outreach. Okay.
Yeah, for sure. Sounds good. Well, Seth, thanks so much for coming on the show. If you guys are listening to this and you loved what Seth had to say, you love the concept of building wealth, providing that generational wealth for your family, make sure to hit up Seth at that link, read that book, and then sign up with them. And make sure you mention me, please. Awesome. We will see you guys on the next one. Thank you so much for watching. And on that note, we're out.